Welcome to the Wealthwise Show, where financial wisdom meets the road to prosperity. Get ready to embark on a journey to make wise financial decisions and unlock the secrets of building lasting wealth. I'm your host, the Wise Investor, and just as a disclaimer, go get some compliance out the way. This podcast is intended for educational purposes only. It is not intended to be tailored personal advice, because I don't give personal advice on the internet. So keep that in mind as you continue to listen to this podcast. That is for educational purposes only. And if you hear a product like a service or a company, anything like that, I'm not endorsing them unless they're sponsoring the show. Well, then it's an endorsement. So just keep that in mind as you get into today's episode of the Wealthwise Show. Alrighty. Hello guys, welcome to another episode of the Wealthwise Show. I appreciate you guys listening in. I'm going to get some housekeeping out of the way. Even though it is an intro, I just like to double check and make sure. That way compliance can approve my episodes. This podcast and anything I say in this episode or episodes in the past and the future is for educational purposes only, meaning that I am not your fiduciary advisor, so please don't take anything I say as personal finance advice, because that's not it. And if you're a client of mine, please reach out to me. There are typical means of contact to get my opinion on the markets or anything like that. So please don't use this podcast as personal advice, as well as making financial decisions. So talk to your fiduciaries and advisors, and do your due diligence. And let's get started. So today's episode is something that I've been planning for a minute to talk about, and I just never got around to it, to be honest with you. And it is basically something that you hear in a lot of disclaimers. A lot of disclaimers and from YouTube and podcasts, even I say a lot, is do your own due diligence, meaning do your own research, do your own, conclusive investigation in whatever you're trying to invest in. Don't just follow what I say or anyone say off of face value, because, I don't know you, you don't know me, and I don't know your circumstances. So learning to do your own due diligence is really important. And one of the things I was thinking about is I tell people to do your own due diligence, and other people in this finance media space also say, hey, do your own due diligence. But what does that mean exactly? So today I want to talk about how to do your own due diligence, how to perform due diligence on, equities. And, figure out if they are a good fit for your portfolio, especially for you do-yourselfers who don't have a fiduciary advisor or anything like that. So let's get started. So there's going to be a few things I'm going to discuss. And one of the main things is knowing, first of all, yourself. And that's going to be really important. And the reason why that goes into doing due diligence on equities is because some people, everyone has different values, and different risk tolerances and things like that. And knowing yourself is very important in that aspect, because if you know yourself, you can eliminate majority of the equities that you're not going to want to invest in by just doing a little self due diligence. And so understanding, hey, if you have a thing about defensive stocks, like, weapon manufacturers and things like that, hey, I really don't want to invest in weapon manufacturers and things like that, people who supply things to militaries. Well, do you know that if you invest in certain, I'm not going to say no tickers or no names, but if you invest in certain equities, that's essentially what you're doing. And that's what I mean by don't just listen to a voice in your speakers or a video. Get to know yourself And that's going to be the first step on knowing what equities that you're going to be interested in investing in. So, first thing first, get to know yourself, and that's going to be the first step. The second step is analyze the sector that you're interested in. So I'm doing a top-down approach here. So you're going to be you because you're the decision maker. Then it's going to be the sector that you're interested in. Now, for those of you who don't know what sectors are basically sections of the market that specialize in certain equities. So you have the tech sector, you have the healthcare sector, you have the industrial sector, you have the energy sector, and so forth. So if you're more inclined for, let's say, oil, gas, and things like that, then you might be more interested in the energy sector. All right. If you're more tech heavy, like, you love video games, you love computers, you love the latest technology and all that good stuff, then you more likely be interested in the tech sector. If you're more inclined on medical things, like the medical field, you're a doctor, you're a nurse, you know the medicines that you're prescribing, and you know the companies that is prescribing the medicine, which companies are make the good stuff. And there will be two same manufacturers, pharmaceutical manufacturers, but they will manufacture the same drug, but the side effects for one drug may be different from the other one because of a certain ingredient they use in the pill or liquid. And these things because you deal with on the front line. So if you're interested in things like that, look into the healthcare sector. Then you got biohealth. Biohealth is a mix of, I would say, tech and healthcare. You got telehealth. You got fintech. That's another one. Financial tech. So there's basically sectors, and then I would say subsectors that you can virtually just mix and match essentially. And understanding the sectors will give you a idea of where to start looking. So once you analyze yourself, hey, this is what I like, this is what I don't like. Then you start analyzing, hey, these are the sectors I'm interested in. All right. So now you got your sectors, you got your personal, idea of who you are. Now the fun part starts, diving into those sectors. So I'm going to give you a little secret. The S&P 500 is probably one of the best investment strategies there is. And the reason being is because they only invest in 500 of the best companies. And that's a great strategy to have, because if you're only invested in 500 of the best companies in the entire market, then you're looking at, a constant, high rate of return. Or I don't want to say a high rate of return. I would say more of a consistent rate of return. I should say that. And that is why the S&P 500 is one of the benchmarks for most people who are money managers. And so basically they've already done a lot of the legwork for a lot of investors. When someone get kicked out of the S&P 500, that stocks typically go down because people are selling because no longer in the S&P 500. When a equity or a stock gets into the S&P 500, then their stock usually go higher. I think Tesla entered the S&P 500 a couple of years ago, and that gave the green light to a lot of money managers to buy Tesla. So it's like, that they pretty much do a lot of the legwork for you in that sense. And they've also separated their portfolio in sectors as well. So they have, the energy sector and all that stuff. So now you know what sector you want to be in, yourself. I would say look into the different sectors of the S&P 500 and look up the top, I would say, 10 companies. And the reason I say top 10, because this is your due diligence. You got the research. So if you pick the energy sector or the tech sector, the top 10 companies in the tech sector for um, the SP 500, I don't know off the top of my head, but I definitely know Nvidia, Microsoft, and Apple is in the top three. And then what you do is, if you already know the company, like, you've already done your research into the company, then, you should be fine. But I'm talking about, those companies that you don't really are not super familiar with. So what you want to do is you want to analyze, one, the total value of the stock. And how do you value a stock? Well, simple. There are a few mathematical equations that you can utilize that I'm not going to say here because it's a lot. You got P ratios and all that stuff, but I'm gonna do super simple. Their earnings. Since a lot of you who are listening to this may be do-it-yourselfers, meaning, you don't need a money manager, you don't need a fiduciary, you want to do it yourself. So these are the things you have to do. Okay, this is what I do for my clients. Listening to earning calls. Reading the finances, looking at their revenue, their profit, their margins, valuing, hey, they are in line with their revenue goals, but not so much in the profit goals, and if you are, doing your due diligence for yourself, that's something that you're going to have to really look into. So most companies' income statements, I said sorry because I hit my mic and I'm not sure if it was made a loud noise or not. But anywho, most companies, not shouldn't say most companies have an income statement, and it will list their revenue, or their net income or profits, and that is the important part of I would say, your valuation into a company, whether or not, because you're not going to want to invest in a company that's not profiting. That's not the point of investing. The point of investing is to get profits. And if your company that you're looking into is not profitable, so yes, you're going to be looking at those things. You're going to be looking at a company's operating expenses. So what is an operating expense? Operating expenses is the expenses that occur for operating the business. If a company has employees, taxes, buying product, buying equipment, the things that keeps the company running, those expenses that occur are factored into revenue and profit and their profit margins and eventually the return on equity. So a company's profit margins is important because if, let's say, they are profitable, but they're only profitable by a tiny bit, that can be not that great depending on the size of the company, how long the company's been in business, and things like that, because it's not growing. The profit's not growing. And the point of investing is growing in profit. So you want someone, or you want a company with a suitable, I would say suitable profit margins, honestly. Like you want that company to be able to, have that wiggle room, have that buildup of a war chest, they call it, that money in the bank. So analyzing the profit margins over several quarters or years is part of doing your due diligence. I know our lead trader at the firm that I'm currently with, they value companies and money managers by market cycles, and market cycles are not a quarter. It's not 2 quarters. It's not 3 quarters. It's not 4 quarters. It's a few years. They monitor it for a few years to see how it do. Because if you are a long-term investor, you're going to be holding these companies probably for generations, I would say. So you would need to give them time to show their trend, essentially, and that may take a couple of years. So understand that when you are doing your due diligence, it may take a minute for for you to actually see the trend, and there's nothing wrong with that. That's all a part of doing your due diligence. So the next thing I would say, which is also something that a lot of people overlook, that I feel like is extremely important when it comes to making these decisions, and that's going to be looking at the competitors. I have a mentor. I'm not going to say his name. And I say a mentor, but I don't think he knows he's my mentor, but I'm using him as my mentor. And he works for a investment bank on Wall Street. And one of the things that I've learned from him is looking at the companies that I'm looking into, looking at their competitors. Like, I might love this particular company, but someone who they're competing with may be a better fit for me. They're in the same sector, clearly. They're doing the same things, clearly, but their profit margins might be better. Their revenue might be better. Their management might be better. Their CEO might be really good. Their CFO might be really good. They have more. They might have less market share at the current moment, but they're gearing up to take market share. So looking at the competitors, I've personally have found a few companies that I'm like, hey man, I was very convicted in this company, but the competition is just better. And at the end of the day, it is just business. So I don't have any hard feelings for, selling my shares of one company to buy shares of a better company. It is what it is. So understanding that another big portion of doing your due diligence is going to be the competition, and that requires researching not just one company, but several companies. So that's why I said 10 companies in a certain sector, because if you look at the tech sector, now there are subsectors. You got chips, you got fintech, like I said, you got a lot of different subsectors in the tech sector. But if you look at Apple and Microsoft, you can say they're competitors. They both make computing products. They both make cellular products. They both make consumer products for tech consumer products. So I would say, I would consider them competitors. And looking into both of them, they're both great companies. So you might find that, hey, both of these companies might be great. I'm just going to invest in both. You can do that as well. But you got things like Nvidia in the tech sector. Nvidia is a chip manufacturer. So, or not manufacturer, a chip. I ain't gonna get into the details. They're more, I would say, a chip designer. They don't have fabs, and I'm getting a little technical. But basically, what fabs are is how chips are actually made. So foundries that actually make the chips. You got chip designers, which is going to be like your Apple, your AMD, your Nvidia, where they, design the chips, but they don't physically make the chips, if that makes any sense. I know that was no point in explaining that, but anywho, yes. So Nvidia may not be, there might be a chip designer, so they might not do more direct-to-consumer products. They might do more enterprise products, and that's where your due diligence comes in. Now you can have a sector that you like, and then subsectors in that sector with these companies. So that also means a lot more research. And Nvidia, one of their competitors is going to be AMD, even though AMD and Nvidia kind of makes two different things. But that's what the street is saying. and then you got Intel. So looking up these different companies is going to help you understand, one, the sector that you're investing in, two, how these companies work to make you to give you a better idea of how to make a decision when you're investing, and three, it will help you to find newer companies, like, that you probably never would think of. So understanding due diligence involves comparing the profit margins of different one or two companies, two or three companies of its competitors, and then you want to ask these questions: is this company a leader in the industry? Are its specific target market? Is the company's industry growing? So those are, remember when I was saying ask questions, those are some important questions to ask. Is this market growing? Is this company is one of the leaders or potential one of the leaders? And I say that because back in the day, Intel used to be the leader in the chip market. They had a big market share because they were on fire back in the day. And AMD, not so much. But in recent times, that completely flipped, where AMD now is the leader and Intel is the laggard. So that requires constant watch, essentially. And so when you perform due diligence and, several companies in the same industry, it can give you a significant insight into, one, how the industry is performing, which can help you understand how the overall market might perform, our sector rotation, and give you a leading edge in what companies that are successful in that industry. And so I know, let me see what the time is. We're at 20-minute mark already. All right. So then you got evaluations. I'm moving on because I got a few other things in my notes. Then you got understand. I can't go over it in detail now because this is going to be a 3-hour long podcast. If I go over PE ratios and PES ratios and all that stuff. So in your spare time, understand price to earnings ratios, price earnings to growth ratios, price to sale ratios. So those ratios are typically calculated already for you in a lot of places, but understanding how they work inside of the markets is going to be extremely, extremely important. And especially when you're trying to make a decision on what to invest in. So understanding that I can't explain all those because that's, like I said, it's going to take forever. Another one is the management. I briefly touched on it. The CEO of a certain company, how they're, what is there, if you're investing in a company and you don't know the CEO of the company you're investing in, then you're not doing due diligence correctly. You need to know who is the person that is basically going to be managing your money, because if you give them money, they have to manage it. They have to put it in the right places. They have to make the right deals. If not, you're going to lose money. It's plain and simple. So understanding the management, understanding the share ownership, who's on the board. If you can't find out who's all on the board, but just get a general idea of share ownership and management, and also understand, guys, this is something that a lot of people don't know, is if you own shares of a company, you get voting rights. So a lot of times these companies will put out a vote for their shareholders. Well, if you own shares of this company, you are a shareholder. So you can participate in a lot of these votes, and you can vote with your shares and essentially, make it work like that. So understanding that, when you're investing in these companies, that you need to know the management. You need to know their thought process on the sector they're in. What's their resume? Are they even, why would, let's say Apple gets the CEO of, what's a Exxon Mobil. the gas state or the gas or oil company. Like, what does the oil CEO knows about running Apple? You know what I'm saying? So, figuring out, hey, what is their resume? Because technically they work for you since you're the shareholder. You know, who's the founders? Who's the executive? Who holds a higher portion of the shares? You know, that's important too because, like, for example, Warren Buffett owns a significant portion of Apple. So he's on the board. He can make decisions if he wants to. And seeing if they're selling shares, because all this stuff got to be disclosed. Seeing if they're selling shares, that could be indication of, hey, what's going on? Let me do some more research into this because they clearly know something that I don't. And it's not like it's insider trading because more likely it's going to be public knowledge. It's just you have to go find it, essentially. There is not going to be readily accessible. You're not going to get an email from the company that you're invested in telling you this is what's happening. You got to go do your due diligence, essentially. So understanding those things, understanding balance sheets is another one. Figuring out how they are generating their money and how they're investing it, if they're investing it, and what they're doing, their liabilities and things of that nature. Then you got the stock price history. So you can look at the charts. Now you went from the fundamental analysis, and see what I'm doing here, guys? Teaching you fundamental analysis. And now you can go into technical analysis. Now, technical analysis is more of a visual thing. So since this is a podcast, it's not really something that you would really see at the moment because, you're listening to it. But looking at the stock chart, seeing how the market price has been moving, or not the market price, but the share price have been moving. Is it moving in the right direction? Is it doing what you want it to do? Things like of that nature. And then compare those to other company charts that you're doing your research in. And then, find out what is Wall Street expectations. Do some digging into, there are some investment analyst companies out there that you can get their analysis on certain companies. I'm going to say a few, but I'm not endorsed by any of these companies. But you got Zacks. I think if you are a Fidelity account holder, you get Zacks at no additional cost. Don't hold me on that, but I'm pretty sure. And Zacks is a good place to find research on these companies. And I know I'm giving you guys a lot, but understand a lot of stuff has been streamlined where a lot of other companies have already did the legwork. Like I said, the S&P 500 did majority of the legwork for everybody in the markets because I just dropped my grabber. Sorry about that. The S&P 500 did majority of the legwork because it made, 500 portfolio of 500 best companies that you can pick from. And there are companies like Zach where they get analyst reports from all different analysts from different institutions, different sectors that you can see. And they can even have sections where you can find out the competitors easily and all that good stuff. So I know it sounds like a lot, but understand, guys, a lot of these stuff is streamlined already for you. You just have to go and find it, essentially. So pretty much, that's going to cover it. There are some other stuff here on my notes. Man, my notes is always larger than the episodes. I wonder if I should make the episodes longer. I'm definitely not going to do that. But understand, guys, the purpose of doing your due diligence is to make informed decisions. And that's one of the things that's going to make you wise. And that's what I'm trying to impart, wisdom. So that's going to be it for this episode. I appreciate you guys listening. I got more to come. And if you want me to talk about something, let me know. I got a few things in the pipeline. I am trying to make high quality episodes every week. Well, as you heard from last week, not every week, like I'm making these episodes. I'm making these episodes in a batch and trying to keep them high quality and then releasing them weekly. But yes, so there's a lot of stuff that I am currently trying to maintain and do. But yeah, guys, I appreciate everyone listening. I appreciate all the support, all the likes, the comments, the listens. Even if you don't like a comment or review, the listens, all that is greatly appreciated. So I'm gonna not hold you any longer than I've already have. And thanks, guys. And until next time, stay wealthwise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the Wealthwise Show. The Wealthwise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.